right, welcome everyone to the Rand Swiss Structured Product webinar, where we are going to learn how to protect capital and maximize return. We're going to take you through a practical example as well. But I think given all the madness that we saw last night after the reaction to to Liberation Day, I think we're going to take you through a little bit of a market overview as well. Viv, do you want to start us off?
Yeah, I'm a very stable genius. This is a Donald Trump quote. And the reason that is important is that you understand that Donald Trump believes this to be true. He believes that he knows more than PhD economists, Nobel Prize-winning economists. He believes that his theory about how tariffs work and how the global economy works is the correct one. And he has the power to implement it. So many people that are thinking that this is just part of a negotiating tactic may be surprised by what's going to be happening down the line.
Okay. Okay, yeah, so the agenda today, we're going to do just a quick introduction, market overview, what's happening. Then we're going to look at exactly how structured products in general work. And then we're going to take you through a practical example of a structured product that we're launching now and kind of explain why, given the market scenario that we're in currently, we believe this is something that should be considered and one of the reasons that we're launching it to clients. Right now, as you know, if you don't know Rand Swiss, we kind of operate across three different divisions, which is the stockbroking, managed solutions, and wealth and advisory. Currently, we're talking about structured products, which are sitting in our wealth and in our managed solutions business, which means we go out to banks, we tailor these products, we create them, we kind of pick the payoff profile that we think is most appropriate to achieve a certain outcome. What we're not doing is we're not giving you wealth advice around the specific product. That really is, you need to speak to one of our CFPs, speak to one of our wealth managers, because they can put this product in the context of your overall financial plan. We believe this is an efficient product. We believe that it's very well priced at the moment, and we're going to show you why. But this is something that if you're buying it, it's an off-the-shelf product. And we'd like to, I would suggest putting it, because they are generally more complex products, put it in the context of your overall wealth plan. And to do that, speak to someone in vertical 3, which is one of our wealth and advisory. If you do feel like you've got the capacity and the understanding of the product and you understand your own risk profile correctly, then by all means, you can buy the product directly off the shelf with us. We'll show you how. Yeah, but that's, I think we typically, I haven't got it in the presentation today, but this would be, this is not nearly as risky as stocks. It would be considered a moderate product rather than, all equity, all shares are considered high risk products. This we would say is moderate to moderately aggressive because we are looking for a coupon that outperforms the S&P 500 in aggregate over time. We've been doing this for a long time as well. We've been running structured products probably 2016, 2017. They've been incredibly successful for clients. And we're going to just show you how we think about them and what the products actually do as well. So Viv, you're going to set the scene for us. What's happening in the world at the moment? I know that's what the market looked like. This is a one-day performance chart of the market last night. So obviously a lot of craziness. We had a lot of the big tech stocks down. And a lot is happening at the moment. All of these headlines are from this morning on all of the major financial news outlets, and you can really see it's chaos. So, Viv, what's going on here?
Yeah, look, I mean, I think this is obviously taking the news event. It's called a news cycle. But let's go to the next page here, and you'll see that this is not okay. Why is this happening? It's not because Trump is a cause of these problems. Trump is a symptom of these problems. And the underlying causes are what I'm showing you right here. And these are trends that go back multiple decades. You can look at, for instance, U.S. debt load. So irrespective of the leader, be it a Democrat, be it a Republican, you're finding that U.S. debt is increasing over time. And you can see that it's actually accelerating. This is an exponential graph that's going up. More than half the debt the US has was basically added in the last decade. Okay. Also, at the same time, you are seeing inequality, and this is going back almost a century. Okay. The last time it peaked at these levels was back in the Great Depression in the 1920s, 1930s, around about that time. Okay. And then also you can see that in terms of purchasing power parity, in terms of the size of the economy, the US economy is actually falling behind what's happening in China. And the Chinese economy is actually larger now in terms of the pure purchasing power parity level than what the US economy is. If you look at currencies and so on, it might be distorting things, but the ability to actually go and buy stuff, you want to make more cars in a place, the Chinese make more cars. You want to make more power plants, the Chinese make more power plants. These trends are not a 1 year, 10-year trend. These are decade-long, some cases century-long trends that we are basically reaping the fruits of right now. And so if that's the case, don't expect the uncertainty that we're experiencing at the moment to disappear when Donald Trump disappears. It's going to carry on until the underlying issues are solved. And we've got to adjust how we invest because of these underlying issues.
Okay, so yeah, I mean, it just, I suppose, on markets as well, like maybe if we just also just touch on what happened last night.
Yeah.
I mean, why are tariffs bad? I mean, what is going on here that the S&P is reacting so negatively to reciprocal tariffs? Because I mean, if I listen to Donald Trump, he's saying to us, well, these are reciprocal. We're trying to level the playing field. You know, he's got a transactional nature. We know that. I mean, what are the chances that, I mean, you know, if we take the Warren Buffett approach here, you know, I've got the CNN Fear and Greed Index gauge up on the right-hand side there. I mean, we're in extreme fear. Surely in an extreme fear scenario, this is the time to be buying. You know, if we're looking at it, you know, be fearful when others are greedy, be greedy when others are fearful. Like, I mean, there's a lot of fear at the moment. I mean, you know, we've got the NASDAQ probably down around 15%. The S&P 500 peak to trough is probably down 12% in US dollar terms already. Is this not just a buying opportunity? We should go straight into equities and say, listen, you know, it's got to bottom out at like 20. I mean, no one knows where the bottom is going to come. But I mean, do you think that there's a real possibility that, you know, given tariffs, because I mean, why are tariffs, first, let's start, why are tariffs bad?
Okay, because basically the overall pie, the whole pie of the world goes up when people can trade. Okay, you think about it this way, right? I mean, when you basically are alone and you basically do everything yourself, this is when you're the poorest. Doesn't matter what you have in terms of land, whatever. When you can't trade with somebody else, you're very poor. When you can trade, some people can specialize in one thing, some people can specialize in other thing, and the amount of stuff produced is going to be greater. Then the argument becomes who gets all this increased improvement. And over time, as you have more and more trade, you find growth goes up. And so right now we have a global economy in which China produces a lot of, like, you know, manufacturing goods, they produce a lot of intellectual property, and the global economy has grown because of that. The problem with this is that over time that you do find that certain people in certain countries, like for instance the US, certain people lose, certain people gain. People that lose are blue collar workers. People that lose are people that don't have university degrees. People that gain are people that do have these, you know, university degrees, do have you know, jobs in the financial sector and so on. And the problem with this is that the overall number of people, I mean, the number one thing about democracy that you must learn is that you must learn how to count. There are more people without a university degree than there are people with a university degree. And therefore, there are more losers than there are winners. Even though the overall pie in the US has grown, there's more losers than there are winners. What Trump is doing right now, he's going to try and shrink the pie. Well, not trying, he may do something that's going to shrink the pie, but it's going to help more people than it's going to hurt. And that is why he's doing what he's doing. Because as he mentioned, his voters are now the blue collar voters. People think the Republicans are the business people and the Democrats are the union members. It's actually changed a bit. The Republicans are now the blue collar workers. The Democrats are now the educated workers. And those are that's the kind of dynamic we're dealing with right now. And Trump, what he's trying to do is trying to help the blue collar worker, and doesn't care so much what happens to the white collar worker. And why tariffs are going to be bad is because you're going to change how the global financial you know, supply chain works. All these efficiencies that you had over the last, you know, several decades being created are going to be torn apart. When you add this kind of, you know, tariffs, 50+% effectively on China, you know, even places like, you know, it's called Europe, 30+%. Those kind of tariff levels are going to change what is efficient to buy and what's efficient to sell, etc. And that's going to make things less cost effective to produce. It's going to reduce the amount of stuff that is produced globally. But what it is going to do is it's probably going to help the factory worker in Ohio, which is what he really cares about. Because like I said, in a democracy, you have to learn to count. And there are more factory workers in Ohio or blue collar workers in Ohio than there are going to be, you know, white collar workers in that country, in that state. Sorry.
And I think, okay, so if we just take this back to markets rather than economics, I mean, markets are a fantastic leading indicator of economic activity as well. So while we've got stock markets starting to drop here, this is predicting that economic activity is going to contract going out. But, you know, all the arguments that, you know, this is self-inflicted, that potentially, you know, we could get a very fast reversal on this. You know, Donald Trump just has to change his opinion, and then suddenly we'll have markets at record highs. And I was chatting to a client a couple of days ago, and they've been managing their own portfolio. It was in our vertical one. So it's a stockbroking client. And, you know, for the last 2 years, they've been managing their own international portfolio, and it's been really easy. They've bought a couple of shares. The shares have gone kind of to record highs. You know, they're kind of looking at it and going, just, I'm a stable genius. You know, I can easily get this portfolio working. And it's suddenly they felt their first drawdown. And they've almost over the last 2 years become accustomed to getting this kind of like 20-25% return in US markets. And I mean, that's just not always the case in financial markets. Looking at the what's the S&P 500 average over time? Probably around 9.5%.
Probably lower than that real terms.
In real terms, probably a little bit lower than that. Now, suddenly we're going into a time where there's a significant disruption that maybe Trump can't back out of it. It's very easy to see sort of a net aggregate, 4% average return from the S&P 500 over the next 5 years.
Yeah.
Very, very possible.
Very possible. And look here as well. The reason that people have been buying and just basically, buy and hold and, buy the dip kind of thing is because to a certain extent, they've been supported by the central banks. So basically central banks have been out there pumping money to the system. The money has to go somewhere. The money has been going to shares, has been going to asset prices. And that's why we've seen share prices, home prices have been going crazy for the last, couple of decades. But that is all, like I said, in a trend line, that's all going to be shifting, because what Trump is doing is not just in terms of this year. He's also doing things like, for instance, DOGE, which is cutting government spending. It's putting a lot of people in the unemployment line. Hundreds of thousands of people are going to be unemployed just in the federal government. And to talk about contractors, that's even larger numbers. He's going to cut government spending, and that is also going to reduce the amount of money out there in the economy. And so he's doing a lot of very negative things for the market, and we could, like you said, easily be seeing that that 2-3% overall towards the average growth rate over the next 5 years. It's really possible. And look, and if you go back in history, like the 2030 depression, it took a long time to basically recover. And when people always talk about, the market recovers in 7 years, they always look at post-World War II. They're not looking at the real long history of the market.
And I mean, we were actually joking about it before the call as well. We both kind of feel like 2008 was yesterday. I mean, that was a 3-year recovery to get back to high, just back to scratch. And we've got the junior guys on the desk telling us they've been through the crises, they've been through COVID, and COVID really was a few months. So I think it's also important to understand that markets can be not underperform, but can. If we've had a number of years of above average performance, a couple of years of below average performance, that's what creates the average as well. But I also take your point, with the global financial crisis, that really, I mean, we saw the zero bound problem. We had very, very low inflation at that stage. So central banks could step in, inflate the economy, print all that money, because there was no inflation. Now suddenly we're sitting in a very different environment where these kind of tariffs are going to stoke inflation, which really limits the power of a central bank just to pump up asset prices again. So how, so we are potentially facing a world where we are going to have lower equity market returns for a while. And I think that's really the scene. That's the context in which a product like we're talking about today really works gangbusters. It really does work. So first, how do structured products work? What are structured products? So I'm going to take it down to really the simplest definitions that I can. So what is a structured product? A structured product is a type of investment that combines different financial instruments, usually a bond and a derivative, and creates a very specific outline based on market conditions. So you can think of it, you can build it around custom investment themes. You can build them however you want. Typically, like I said, bond and a derivative. But we can kind of create our own contingent payoff profiles. And there's many different shapes, they call them shapes, that we can create. So we've created one today that we're going to take you through, which is called an auto call. But essentially, the key feature of most structured products is that they give you a level of capital protection or part capital protection, which means when markets fall, you are protected. So that's why it takes you down from a high-risk product to more of a moderate risk product. At the same time, you have the ability to enhance and change return profiles. And I remember Viv chatting about this probably 6-7 years ago when he was talking about structured products with clients. An equity or a bond, these are instruments that are financing instruments essentially for companies. What a structured product is it's a product tailored to specifically give an outcome that an investor wants, not really what the supplier of the what do you call it, investment instrument called. It's a combination. It's a structure, as in we take a whole lot of different products, put them together, wrap them up in the product, and create a contingent outcome. And usually it is a combination of both. You're going to have an enhanced return, and you're going to have some form of capital protection as well. as I said, what are the two main building blocks of this? Usually bonds and derivatives. So, often derivatives, I mean, derivative pricing is always one of the big key derivative pricing inputs is volatility as well. So generally, when you get these very volatile markets, and I think the VIX, which is the volatility index, people call it the fear and greed index, that hit 30 last night. So when we ping for pricing, so when we ping all our banks for pricing, we're getting very unique pricing opportunities in this market because the volatility is high. And also, I mean, if you look at bond rates compared to, let's say, 5-6 years ago, they are higher as well. So we're getting some profiles. I mean, typically, like the profiles that we're kind of seeing at the moment, we haven't launched a structure in a while because market indices haven't really been there. But suddenly we're getting these nice pricing options coming back from the banks. So that's those are the two building blocks on two of the instruments that you use within the structured product. And then why do people use structured products? So one, as I said, capital protection in volatile times where things are very uncertain. You can typically get one decent return profiles off your structures. But the second thing is, there's a level of anxiety, certainly among clients in the client base. And when you're looking at markets go down and down and down, and you start thinking about it, wait a minute, the market could be under pressure for a while. Having that capital protection lets you sleep at night on your investments as well. Obviously, the enhanced returns, they really boost up the return when markets are range bound or flat. And then they can give you access to markets that you can't normally invest in. The one that we've got today is pretty vanilla. We're linking to some of the world's biggest indices. But again, like I said before, they can tailor strategies to achieve specific goals rather than just becoming almost a price taker for the financing institution or that. So we can kind of make these do what we want them to do, which is really cool. Okay, so today's structured product. So we've got the USD triple index auto call. So what is this product? So what are our contingent payoff profiles on this? So like I said, we're linking the product to the S&P 500, the Nikkei, and the Euro stocks. So maybe if you want to take it on there, like why select these three indices versus why are we not going? Why is China not in there? I mean, I think we're quite bullish on China at the moment. Why aren't we picking Argentina? What is the thinking behind the S&P 500, the Nikkei, and the Euro stocks as our combination of indices?
So basically, we're looking at the biggest indices in the world, right? So the S&P, the Nikkei, and the Euro stocks are the biggest. The one thing missing out is China. The reason we're leaving China out of it is because China is not quite as correlated, we believe, as these particular indices. Now, the thing of correlation is important here because when we create these structures, they are almost like engineering. It's like it's financial engineering. They're engineering, principles that we put into place that make these things more efficient, less efficient. When it comes to a triple autocolors or a worst of autocolor, the one thing you want to do is make sure that all the things that you're dealing with are correlated. And we don't believe China is correlated as much with these other things. What does correlation mean? It's like, for instance, imagine you playing a one of those kind of like triple like bet kind of things, for instance, in soccer or whatnot. And then you think that this, for some reason, if United wins, City is going to win as well, whatever the correlation is. And if that is the case, then you want to bet both United and City together because the combination of those two things is going to be a higher payout, but it doesn't require, two totally independent events to happen. At the same time, if you look at, for instance, something's totally uncorrelated, then you are going to get a higher risk of one thing not working out and one thing working out. And in this particular kind of thing, you want all these things must work out for the payoff to happen. And therefore, if they're all correlated, they're all likely to work out together, as opposed to maybe one not working out and two working out. And so, yeah, this is the thing about these particular articles. We think that correlation is higher among these three indices than they historically have been. And therefore, we think that you're getting a higher return with a low risk profile for this particular article.
And I suppose, because we can kind of put anything we want in here, we could put NVIDIA, Apple, and Meta in here as well. Yeah. So what's the idea behind picking indices over stocks on here?
Because the indices are basically more stable. Here's the thing. We don't need these things to go and do 50, 60, 70%. NVIDIA, if you're going to invest in NVIDIA, you want to do 50%. If NVIDIA after 5 years comes back and gives you 5% in total, it's a disaster. If all these companies, indices give us 5% after 5 years, we've made our money. We just don't need them to fall. So the bigger things are, the more stable they are. And therefore, that's why we are choosing indices. There are autocalls that will give you individual stocks, but individual stocks are very vulnerable. What happens tomorrow, for instance, NVIDIA, if Jensen dies or has some kind of injury or something? What happens if you had Tesla in there, Elon Musk gets injured or something? You've seen in the past that individuals, once-off events can really badly affect companies, even companies that have been incredibly stable for a long period of time. Whereas indices are much more predictable.
Yeah, S&P 500, 500 different companies within that. Even if a couple of companies go totally bankrupt, you've got the stability. It's like a fish tank. Small fish tanks, very difficult to manage. Large fish tanks, the water becomes very stable, actually much easier to manage for anyone that's had a fish tank in the past. Okay, so what else in this auto call? So the maximum duration of this auto call is 5 years. So typically this is a 5-year investment. So when you're investing in this product, you should think that I'm putting money away for the next 5 years. That's the potential outcome. As you'll see when I go through the back testing, there's a more than 50% chance that this is going to cash after 1 year, because this product gives you multiple chances to win. But essentially, when you invest in this, the maximum lockup period is 5 years. So invest with a 5-year mindset. Capital protection is 30%, and your annual coupon, so this is a US dollar-based coupon, is 12%. So if the indices fall, even if they fall 20%, you're going to get your money back. If it's deeper than 30%, then it doesn't have capital protection. But I'm going to go through that in more detail later in the presentation. The coupon 12%, so there's a 12% dollar-based coupon that's paid on this product. Now you'll see or deeper or better next to each one of these. So remember, when we're pricing these, we're pricing into a live market. So things are changing every day. The index strikes that we're going to get today are different from what we would have got yesterday because of the market fall. But at the same time, because of volatility is an input, because yields on input, the pricing changes all the time. So we have to build in quite a lot of fat into these products. Now, what we do generally is we marketing at the worst possible levels that you're going to get. The worst capital protection you're going to get here is 30%, and the worst coupon you're going to get is 12%. Now, just to put that coupon in perspective, like I said, 8 to 9% average S&P performance in aggregate. This is giving you 12, significantly above the S&P 500. If you think how many fund managers are outperforming the S&P 500, not a lot. Not a lot of fund managers, equity fund managers are outperforming it. If this does what it does, and we have our 3 indices positive at the observation dates, which I'll explain in a bit, you're going to get your 12% coupon outperforming the S&P. And that's why I say this is a moderate risk product, but I skew it slightly higher because we do have quite an aggressive, when I say profit target at 12%, that's a high coupon given what we're doing here. Now, we can put the capital protection down to like 95%, 100% capital protection. All that's going to do is drop your coupon. So your coupon might only be about 8% then. So this, like I said, this is kind of like where we see the sweet spot. We run an optimizer across all the different indices that we can use. We run it across different depths of protection, different coupons, to try and get that sweet spot. We believe this is where the sweet spot is. On current pricing against that we're doing at the moment, we're getting about 14.5% coupons currently, and that's including all fees, everything. Our fee never changes. I'll talk about the fees in the next slide, but our fee never changes on this. When we come to strike the product, all the benefit of the enhanced coupon or better capital protection flows straight through to you as the client. So if we get a big change in yield and volatility, and suddenly the coupon is sitting at 16%, when we strike, you will benefit from that 16% coupon. And when we give you your term sheet at the end of it, it's not going to be 12, you're going to get 16. If we can only get 11%, which, like I said, we've built a lot of fat into this one, given the uncertainty around market at the moment. That's why we're marketing at 12. But if it comes out at 11, we'll say, sorry, guys, the market's not there. We can't get our trade away at 11%. And we just return the capital to you and we look for the next investment. So this is the worst case scenario in terms of what your capital protection is going to be and what your coupon is going to be. Now, the other feature is, I suppose, 9 chances to win. So this is maybe a little bit more complicated. So normally when I do, I love the growth notes. I've explained a lot of growth notes in the past, where you essentially lock up your money for 5 years. And at the end of the 5 years, we look where the indices are and you get your payoff. Now, what an auto call does, and that's where the auto call feature of this product is, it gives you additional chances to exit the product. So typically the way this one is working is, for the first year, your money will be invested. So the minimum amount of time your money will be invested is 1 year. But then at the end of the first year, we're going to look where the S&P 500 is, where the Nikkei is, and where the Euro stocks is. And if all of those are positive, we're going to give you a 12, worst case scenario, a 12% return. then if, let's say that the S&P 500 is still down over the year, but the Nikkei and the Euro stocks are positive, we're going to say, okay, wait, the S&P 500 is still negative from where we struck. It just rolls on to the next contract. So then what happens is we go, okay, cool, we wait another 6 months, we look again. Then we wait another 6 months, we look again. And I'm going to go through this in a little bit more detail later in the presentation, but essentially we have 9 observations on the product in which case you can exit the product early and you don't have to run the full 5 years. Now, Viv, maybe you want to explain why that's nice. I know you've had a situation like this before.
Yeah, so I mean, we're living in a more volatile time, okay? And in the more volatile time, we don't want to have a small period, maybe 6 months or even 1 month or even 1 day, which basically a determination is made on a 5-year structure. So the case that we had a problem with, and why I really got convinced about this, was near COVID. We had a client who had been in for 5 years, and basically a month before his structure was due to basically expire, he was going to get an 80% round return. Unfortunately, COVID hits, and then the market crashes, and then he ends up having to basically take his money out in a 2-week period in which it was below where he started from. There hadn't been a 2-week period before or after that, or where that was true. If he had gone back 2 weeks before, it would have easily been above the level. A couple of weeks after, again above the level. But there was this little 2-week period where it was at the wrong price. And this 5-year product basically gave him back his money. And that was
so there was no loss of capital or anything like that, but from going from an 80% return to a flat return, just because, yeah, sure, if you had invested in COVID, it would have been an issue. And sure, he did get his capital back at the beginning of COVID, so he could have gone and bought the market, and the market would have recovered. So it did its job, but we kind of want a higher degree of predictability, if I want to put it that way. We want to make sure that the return is positive. So getting these additional observations allows us to almost ensure that the client gets a positive result rather than a flat result. And I think that's why it's nice to have these like additional chances to win, all these 9 observations.
And one more thing to point out, I mean, we designed this whole thing. All these points go towards what our belief about how the world looks like at the moment. The capital protection you'll see is what we designed to have never basically hit a loss in the last dozen years. The coupon is, like Gary said, a level that's like 50% effectively above the historic return on the S&P 500. 9 chances to win is because of the fact that we think this is a highly volatile time. Same with the duration of 5 years. I mean, everything we designed here was designed in order to give what we think was a reasonably good return on almost a much higher chance of happening. And that is why we designed it in these particular.
Yeah, because of course we can make these 3 years. You can do a 1-year auto call. We can make it 6 years. We can make it 10 years. We can do what we want. But a 5-year period is like I said, when we run optimizers, is kind of where you find the optimal return. So, okay, the other features. So this is a fully offshore product. That means that both your deposit and your return is going to be in US dollars. It's a US dollar product. That means that you use your single discretionary allowance or you use your AIT PIN. I mean, we do AIT PIN applications for clients, but typically this is outside of South Africa. So how do you hold this? Like, you hold this at a custodian. So that's point 4. It's actually a note, and I'm going to go through the mechanics of a note now. That gets held at either DMA, Velocity, Swissquote. You can hold at other custodians as well, as long as you have an international custodian. You can buy the product, and as long as they clear through Euronext, we can essentially send the note to your broking account overseas, and you'll see it as a line item on your statement. So there are a lot of structured products, like some people create them as companies, or they create them as endowment vehicles. You're getting to the cleanest part of how a structured product works. You're getting to the underlying promise from the bank, which is the note. The minimum deposit on this note is $20,000. So that's the minimum investment size that we can accept from a client. Now, pricing improves also with scale as well. So we've already got more than $1 million committed to the specific structure. So again, we're going to get a coupon enhancement. That 14.5% that I priced yesterday was actually on a $500,000 trade. Like I said, we've already got more than $1 million committed to this. Now, the more money that we have in the product, the higher the coupon will become. Because again, it's an economy of scale. It's volume pricing. If you go to, a farmer and you say, I want to buy 1 apple, that apple costs you, I don't know, 10 Rand. If you go and say, I want to buy 1 million apples, the farmer says, well, I can give you that at 6 Rand. It's exactly the same with structured product pricing. So often, like what happens is, clients often, they might miss the date because the closing date is going to be the 17th of April. So that's not next Friday, the Friday before, or the Friday after. We are going to close at that because we've already got the size committed. And often clients go, oh, but I couldn't free up cash. Can you kind of create the same product? We can, as long as you have a minimum of 250,000 US dollars that you put into the product. We can create a unique note that is just you as the investor. The problem is you're no longer benefiting from scale. So when this comes through with kind of a 14% coupon, if I have to do the exact same trade for you the day after with a $250,000, you might only get a 13 or 12.5% coupon. So that economy of scale is big. And as a smaller investor investing $20,000 into this product, you're benefiting from the whole scale of our client base and all the investors in this product. By getting an enhanced yield on it, which is why you want to kind of take the formal structure that we can trade them bespoke if you've got a very unique view. But it is generally better to get on the bandwagon with everyone else because of the pricing. And yeah, then I suppose the last point is, what is this? I've already said it's a note. So essentially it's a promise. And now we haven't given you the underlying bank because we're kind of bank agnostic at this stage. We don't really mind which bank is writing the promise to you, if you want to put it that way. But the way that we think about the bank is, you look at credit ratings and you look at the credit ratings on the online. Who is making this promise to you is what we're saying. Now, like I said there, the bank that we use ultimately is always going to be an A-rated bank. We want an A rating at S&P, Moody's, and Fitch. Now, if you look at the chart here, so Morgan Stanley, we have a lot of credit at Morgan Stanley. A lot of these notes we've done. Typically, our bank counterparties are Morgan Stanley, BNP Paribas, Barclays. We've got a little bit of BBVA paper as well because BBVA we like. I've got a small amount of Citigroup paper as well, but those are kind of the banks that we tend to use on this line. I'm just going to highlight, I'm not going to pick on any South African bank individually, but if you look on the left-hand side, I don't know if you can see my cursor, but you've got Nedbank there, which is actually a B-rated bank. If we go look at Absa up at the top, also a B-rated bank. We look at even Investec. Investec is a BBA1 rated bank by Moody's. So in terms of the local banks, none of those local banks would have actually made it onto our screener. So when we go in and get our promise from a bank, we're talking about a bank more stable than anything that we have in South Africa currently. And these are all the banks that we pick. So again, it comes down to getting, like, we want to, again, optimize. And I've said it in so many presentations, our whole philosophy at Ranswers is to get you as close to the underlying asset as efficiently as we possibly can. We want to strip off as many layers of fees and unnecessary things that we can. So that's why we're going direct to this list, essentially this list of banks and pricing. We've thought about Marex for a long time because it's actually a non-rated, because like the coupon that you can get at Marex is ridiculous. They've just listed as well. But at this stage, we have never produced a note for clients that is not backed by an A-rated international bank. So that's kind of where like all of the notes that we've done. Now, what does credit risk mean? It means this is the people that are guaranteeing your product. So let's say Ranswers goes bankrupt and we all disappear. Hopefully not after 10 years, and we are pretty stable ourselves. But if we were to disappear, it's not that your investment, we are not guaranteeing anything. Your guarantee on this investment product sits in an international stockbroking account, and the paper that you're receiving is from an A-rated international bank. It means that we can go bankrupt, your international stockbroker can even go bankrupt. You will still have this note. It will still pay off as long as the contingent payoff profile is there. So that's the underlying structure of it. And you essentially have a claim against one of these big international banks' balance sheets. Now, so in what situation could you potentially see a loss on this? If Morgan Stanley was to go bankrupt, then technically, yes, you could potentially lose the investment, but that would mean Morgan Stanley's share price would have to go to zero. And essentially you would still get probably a partial payment on your debt as well. Now, just to put that in context, if we look at, we've got a practical example of this. Credit Suisse went essentially bankrupt fairly recently in Switzerland. One, it didn't make it onto our scan. We have no Credit Suisse paper because it wasn't an A-rated bank. Generally, for all the criticism that the ratings agencies got after 2008, ratings agencies are still one of the best ways of kind of understanding credit. even then, you wouldn't have lost money in Credit Suisse because the Swiss government stepped in, so did UBS. UBS bought out Credit Suisse and honored the debt anyway. They didn't write their share price down to zero, so your credit would have even been safe in a bankruptcy event like we saw with Credit Suisse. So it doesn't make it onto our scanner, and typically the banks that we're buying on, like it would have to be something so catastrophic, it would be almost ridiculous. But I want to kind of make you aware of what is an actual structured product and what
you
is
just understand, right? I mean, to understand, this is one of the areas where we are extremely cautious and probably overly cautious for without justification, let us say. If you are happy to put your money into a South African bank like Nedbank and have like more than a couple $100,000 in it, you are taking more and more risk than you are taking on. Like, I mean, I've got a bank deposit, like a Nedbank, for like a couple $100,000. You are likely taking on more risk than having a structure at even one of the banks that we are talking about here that we would have refused. Reason being is that if Nedbank goes bankrupt, you only are protected for like 150,000 rands, I believe, is the level of protection for depositors. And, how worried are you about putting money into a Nedbank or into, an Investec? Not that worried. The reason that we are extra cautious around these particular things is because, we do think that the world is a bit more, crazy going forward. And so we're willing to sacrifice 1% or 1.5% in some cases to get that little extra bit of security than not. But this is like an event that might happen, realistically. One of these, even a triple B rated bank, one of these things going bankrupt, if you just put in money into them in 100 years, you would not expect it to happen even once in 100 years, quite frankly. You know what I mean?
Yeah.
This is a very unlikely event. But we just basically, this is just one of the cases where we are over engineering. Look, the way we design these structured products is we take out any like risk that we can take out without any loss to return. We also basically don't have any insurance that we don't need to have for no reason. This is probably one case where we do have extra insurance for no reason.
Sure.
But that being said, the overall portfolio, might perform in a certain way. Where 99% of the people that invest the money will be better off. We had a higher risk on it. But if you are the unfortunate person, that's the 1% where things go wrong for you, obviously it's going to affect you, quite badly. So we don't want to even take that one chance. So that's why we are here. If any of these banks, I mean, you could choose any of these banks, put your money in there, and wait 100 years, and you would probably be 99% certain that you get your money back.
Yeah.
Okay.
Yeah. 100%. So that's the credit risk. Okay, so now just to explain, I've kind of briefly gone through this, but we've just got a slide on it as well. So this is, and we are going to share these slides afterwards so that you can kind of work through them at your own speed. But this is just, I suppose, a diagram explaining like how do autocalls work? How do these triggers work? So we know we've got the three indices. So we've got the S&P 500, the Nikkei, and the Euro stocks. And we know that once we've invested, let's say $100,000 into the product, 1 year later, we're going to take an observation. So that's going to be your first chance to win, the first observation. We're going to look at these three indices and we're going to say, are they all positive? So that's the second block there. Are all the underlying indices above the autocall trigger level, which we take at 100%? So when we strike this product, when we do the strike, we're going to take where's the Nikkei today, where's the Euro stocks today, where's the S&P 500 today. Fortunately for us, we've actually got this lovely sell-off to buy into as well. So we've already got a 15% almost discount on some of the indices. Now, in a year's time, if the indices are above this level that has already fallen back a little bit, will it trigger? Yes, it'll trigger, and you'll get an early redemption and your full capital returned. If one of the indices is down, let's say that the Euro stocks for some reason hasn't recovered, or the Euro stocks and the Nikkei has done great, but the S&P 500 has remained low because of the isolationist policies we've seen out of Trump, then what will happen, we'll say, no, the S&P 500 is negative. So we just, there in that situation, not all the underlying indices are above the trigger. So we go to the second observation. So then we iterate. Every 6 months, we go and look at the three indices. If all three are above, the product cashes and you return. So in a 12% scenario, you'll get 12% for the first year. And let's say 6 months later, you cash, you get 12% plus 6% for the second year. If it runs the full 5 years, and on the last kind of observation, so on the final observation, all of like you just get this little tick up on the index that was underperforming. You get all your coupons. We call them snowballing coupons. So we take all the coupons that you would receive, and you get them all paid out in a lump sum. Now, I suppose it's quite important to just understand that as well. the way that we structure it, we can structure this so that you get paid a cash flow on every coupon. We choose not to do that. We choose to use what's called a snowballing coupon. Now, the reason that we use that is snowballing. You just think about it. All the coupons are rolling up like a snowball, and they just get bigger and bigger and bigger until the thing matures. Now, one of the reasons for that, and it's also one of the reasons that we tend to steer clear of the 100% capital protected products, is that it does have an advantageous tax treatment as well. And when I say that, I mean, of course, speak to a tax practitioner about this. But the way that we understand it in terms of the receiver, if you have capital at risk, is the one test. And if the product is, had an intention of investing for more than 5 years. This product has capital at risk and it has an intention of investing for more than 5 years. And there's no cash flow payment that looks like interest. It all comes out as a capital return, as in you put in 100,000, you get all your coupons snowballed, and you get paid, let's say 160,000 at the end of the 5-year period. So it looks like a capital return, which is obviously a more advantageous tax situation. Of course, I mean, that's how we understand it. And I would still say go and get tax advice if you're concerned around that. But so far, I mean, like I said, we've been running these for 10 years. I've never heard of anyone having to claim this on the income account rather than the capital account. So what happens in the final situations if they're not? So what happens if that one index is down and it's down and it hasn't recovered? Then what's going to happen is you're going to only get your capital returned. And if it's down more than the 30% barrier, then you're going to have a 1-for-1 reduction in your payoff profile. Don't worry if that was very quick, because I've got some pictures to show you how that works now.
Yeah.
So this is now Viv made a great point when I showed him the presentation this morning. He said, I've got 4 payoff scenarios here, which are essentially the 4 different payoff scenarios. It's also a very unfortunate because it makes it seem like it's like a 1 in 4 chance one of these 4 things are going to happen. That's actually not the case. And I'm going to show you in the next slide why not. But we're telling you this because this is, again, it's my overly conservative nature. I want to tell you the absolute worst case scenario here. So the worst case scenario is, let's say that the Nikkei and the Euro stocks go gangbusters, the red and the blue, but let's say the S&P 500 ends up after 9 observations, so after 5 years, being down 40%. What will happen there is what you're going to take is a 40% haircut. If you invested $100,000, you will lose 40%. It will be as if you bought the S&P 500 index only. So you kind of get the worst performing index, and you're going to lose 40% of the capital, and you face the full market risk. That is the worst case scenario. Now, you might look at this and go, Gary, this looks absolutely terrible as the first payoff scenario. So obviously we've done back testing on this as well. Like I said, it's a very unlikely scenario that this happens. And it's something that we want to put capital at risk because it obviously gets us a favorable tax treatment. But this is now the back testing on this exact auto call, running back, more than a decade. So it's about 12 years. In that, we've had the COVID crisis, we've had the Russia-Ukraine war. 2022 was like a slow bleed down, like 20% in the market. We've had a very, I suppose, fractious, at least last 6 years since COVID. Markets have been very, very choppy, very, very uncertain. So if we go and do the back testing, we've tested like 1,500 different observations. This product has auto-called with a profitable return for investors every single time. There's never been a time in the last 12 years, even if we tried investing on every single day, even if you had invested in the peak before COVID, if you had invested in it, there's no time in which this product wouldn't have returned a positive result, as in you wouldn't have gotten your 12% coupon. And if it's never even returned just your capital back, I can tell you it's been nowhere close to a barrier breach, which means that we have to have the barrier breach, that 30% capital protection, having one of the indices down more than 30% over a 5-year period. There's been nowhere near that. It hasn't even been flat over a 5-year period. So the probabilities are up at the top here. There's a 52% chance, 52.7% chance that this will probably return positive in 12 months. You add another 13% that in 18 months you'll be out, and then you can kind of see the distribution going all the way out to the full term of the product. Now, if I look onto the next one, that's just the thing. And you can see there has been significant volatility in this, like as in, I mean, we've had crashes in this in these indices before. They have not breached the 30% barrier. Now, even, like I said, like Viv was saying earlier, we probably are more conservative than we have to be. And in which case, like if we can get a decent coupon and let's say 14%, but we can deepen the capital protection to maybe 35 or 40, I think there's a good chance that we will do that on strike, and we might just give you a little bit more capital protection, even though I don't think it's required. I think we're paying for insurance that we don't require, especially given that we're already in a trough at the moment. We already have had a bit of a pullback. So, we know we're not investing at peak because we're already down a little bit. So we're getting a good index level at the same time. So in the backtesting scenario, like the 30% capital protection never triggers, and it always has triggered positive over the last 12 years. So now I'm going to say the best case scenario, which is payoff 2, and this is the most probable scenario, like at 52%. The product, all the indices, we invest in kind of 15% down on some of these indices. I think the S&P 500 is down about 12%. Let's say that, little bit of ructions with Trump and markets, and suddenly maybe we see a little bit more transactional nature coming out of Trump, and markets start to recover, and all indices end, let's say 5% up at the end of at essentially this time in April next year. We're going to give you a 12% return. The market might have done 5, you're getting 12. If the market's done 20, you're still getting 12. I mean, this is not, we're giving you a coupon specifically with the capital protection. And that's the most probable scenario. Why do we say it's the best case? Because then we can immediately roll the product into the next auto call. So we start to compound the return as well. So then we can look at it, we can look at the market environment, we can say, actually, we want to drop the Nikkei out of this because we don't have a view on Japan, and we're going to put Euro stocks in instead. So we get to tweak the product and optimize the product in terms of where we want to be invested. And of course, we now, instead of investing $100,000, we're investing $112,000 in the next product as well. So that is the best case scenario.
I just want a little kind of weird kind of Trump thing here. If Donald Trump, right, there's obviously he's a great businessman. He had taken the money his father had left him when he had died. He had gotten 12% a year from that time till now. It'd be worth more than 10 times what it's currently worth. Okay, so this is what 12% does. If you can lock it in each year, a 12% compounding return in US dollars is a spectacular return. It's not a kind of like a return you take just because it's like the best you can do, or it's not. It's just like a middling return. This is like the outperformance of 12% versus the S&P 500 is almost double what Warren Buffett has done historically. Okay, that's the kind of return we're talking about here. So if we can lock this in after a year, people might say, oh, we only got 12%. 12% historically in dollar terms is significantly above.
And I think the way that I talk about it, like 12%, is like, I'm like, oh, I'm sorry, 12%. But it's also like, I'm like we work a lot in the stock market. So, you kind of get used to seeing things like Tesla up 5% in a day, 30% return on Intel. But I mean, these are much more speculative types of returns that you're looking at in a stock return like that. The problem is, in aggregate, stock returns also go down significantly, whereas this has that level of protection. So you're comparing this to what, like a 4% bond yield, maybe a 3.5% bond yield. So you're more comparing this to like a cash-like return, because it's that kind of mid-spectrum on the risk on the risk. It's kind of midpoint on the risk spectrum. So so 12%, that I would say is the optimal return, and by far the most likely return as well, as in more than a 50% chance that this happens. Then we've got like the safe case. Like I said, this is actually, based on the back testing, the first scenario and the third scenario over the 12 years of back testing is a 0% chance that this happens. But I want to show it to you. If this happens, where let's say that we call it the safe case, let's say the S&P 500 doesn't recover for a 5-year period and does end at observation 9 down, you still get all your money back. You put in $100,000. Yeah, you didn't get an interest rate over the period, but something has gone dramatically wrong with one of the world's 3 largest indices representing large economic blocks. And that's, so like I said, there's essentially, on backtesting, a 0% probability, but I have to show it to you because, the future is uncertain. You can get a scenario where indices are down for a long period of time. And then finally, the kind of the final observation one. So this is the one that I was speaking about earlier. Let's say that Euro Stoxx kind of middles along, doesn't do anything, which it has done for a long time as well. Let's say S&P 500 shoots up, but the Nikkei falls back. And, on observation 9, it's been negative the whole time, but on the last observation, what happens? It just pokes its head up and gets positive. It's not like you're only going to get a coupon for that 9th observation. Like I said, it snowballs across the whole product. and you get essentially 12% plus 12%. So you will get a 60% dollar-based return. So it's simple interest, not compounded, which is why we prefer the scenario in which we can cash early. And yeah, it's a 60% dollar-based return. Like I said, that's based on a 12% return. Like I said, I think that we might be able to push this as high as 15. So in that case, you would get a 75% dollar return, depending on the ultimate coupon, which is why I said, or maybe 75%. So, a lot of clients, when I show them these slides, they go, oh, this is the best scenario because that's how I get the most money. But it actually isn't. The best scenario is actually you put it in, a year later it cashes, you get your 12%, and we roll the product, and you get to compound the return.
And a new level of protection every year.
And a new level of, you get to reset the indices each time. So that's kind of where we are. So to get started, it's really simple. Like I said, like we do this under our Cat2 business. So as long as you've got a mandate with us or an existing account, if you don't, you just go to randswiss.com/account, stick in your details. If you're not a client, you need to send us FICA. If you are a client, it's literally as simple as saying, hey, Gary, hey, Viv, here's an email. I'm really interested in your structure. I've got $20,000 in my broking account. Or I'm going to transfer it. Obviously, we can do all the FX and the AIT pins. Like, we won't have time to do, like, obviously an AIT pin for you for the structure. I mean, that typically takes about call it 2 months to get the 10 million rand allowances out. But I think a lot of it, I mean, we've been sending a lot of research, not when I say research, I mean, we sent you the thing from Piet recently trying to say, listen, we've got good technical levels on the currency. So I think anyone who listened to that and got funds out at kind of low 18s is looking pretty spectacular now that we're at 1910. But yeah, typically we would be using offshore dollars. If you've got offshore dollars sitting in an offshore bank account, I mean, we can set you up a funding account, like a custodian account if you don't have one. You literally transfer the funds in, send us an email saying, hey, I'd like to put $20,000 into the product, and away we go. Like, the onboarding process is pretty seamless these days from when we started, which used to be pages and pages of application forms. So we've really slimmed that down and made the onboarding process a lot easier. So I've kind of left questions to the end, and I think we've got probably 10 minutes for questions if you want to run through it. You can just hit us up in the chat window or in the Q&A box. So we do have some questions here. Okay, from Benji, if you are currently invested in the S&P 500, then options transfer out into USD autocall or additional investments into the autocall.
Look, historically, here's the fact: if you had the S&P 500 over like a 20-year period, okay, you probably would think that this thing would outperform. You know what I mean? Because it historically gives you 12% per year. If you have a shorter term period, like for instance, the next year or two, it's quite possible the S&P recovers. The one thing I would say to you is this is why things are so volatile. It's a couple of days ago when there was an assumption that the tariff was going to be 10% across the board. We saw markets go up like 2+%, on that news. So if Trump comes out with some kind of, for instance, plan or some kind of backing down, which he has done, for instance, with both Mexico and Canada, I think 2 or 3 times so far in the last year, or in the last basically few months, we would see, for instance, not just we would recover the losses of the last couple of days, but we'll probably go a couple % higher than that as well. So that would be like an 8-9% return in maybe like less than a few weeks. So I think that if you're looking at like a short-term thing, I don't know if the S&P is going to be a better or worse thing. But I would say if you look at it over a longer period of time, this would probably be a better investment in the S&P because, like I said, an average 12% versus 8%.
Yeah. So and maybe I might be misunderstanding the question as well. So just options to transfer out of the USD in autocall or additional investment. So I mean, it might also be a mechanical question: is can we do like a pledge? I mean, we've done that in the past with clients, where you I'm going to have to get back to you on that, because essentially what we can do is, if let's say you have been invested in the S&P 500 for 20 years and you want to kind of almost donate your S&P 500 without selling it, like there is something that you can do which is called a pledge. where you kind of pledge your S&P 500, you get essentially cash given to you, and you can buy the auto call against the S&P 500. It would depend on your account. I'm pretty certain, through Swissquote, you can use those Lombard loans to do that. And there is a collateralization facility at DMA. So if, let's say, you've got $1 million in S&P 500 and you want to add the auto call to your portfolio, but you don't want to put new cash in, and you also don't want to sell your S&P 500, I'm pretty certain we can actually collateralize. I know we can do it at Swissquote. I'm going to have to check with DMA to see if they are prepared to collateralize against the instrument. I'm kind of 50-50 on it. So I'll get back to you on that.
But that would increase your risk, of course.
Yeah. Well, of course, you're adding leverage then, because you'll still have in that case, you'd still have your S&P 500, but you'd just have the additional auto call as well in your account. There's a way to do it. Yeah. So let me get back to you on that. But ultimately, yes, technically, you would either probably have to, if tax wasn't a concern, you'd probably have to sell out of some of your S&P 500, free up the capital in your account, take that capital and invest it into the auto call product. Or obviously you can make a new contribution into your account as well. That's definitely possible. No problem. You can keep your S&P 500, put an extra 100,000 into your account and buy an auto call. That's typically how it is. What you'll see there in your account is you'll see your S&P 500. Let's say you've got the Vanguard S&P 500 ETF, and then you'll just see your auto call as a line item underneath it, and you'll have the two values. So a new deposit, it would sit in the existing account that is holding your S&P 500, if that's the question. Why do you not include Eurostoxx 600 instead of the Eurostoxx 50? That's a good question. But why are we looking at a narrower index rather than a broader index?
Look, basically, it's likely to do with pricing here, you know what I mean? So we are looking at the areas that we think are going to be, benefiting. So you're not going to likely have like a Eurostoxx 50 underperforming the 600 over a period of time. And it just comes down to the slight pricing differential. Things that are a bit more volatile, things that are a bit more, move a little bit more, just gives you a bit more return. And so there's no reason to choose the larger one instead of the smaller one if it's not going to give you a slightly better return.
Yeah. So also looking at that, we ran the optimizer, which I think it's across a lot of different indices. And it actually what the optimizer does is it returns all the potential coupons as well, depending on the underlying indices as well, so that we can kind of work around it. So, we looked at everything from Russells to NASDAQs to Swiss indices to, we really had a broad swath of indices. And what happens is once you optimize for the different combinations, it would have pulled up Eurostoxx 50 versus the Eurostoxx 600. And I tend to agree with the volatility and the performance of the 600 versus the 50 is very, very similar, even though the 600 would technically drop our coupon, I would imagine, because it is that slightly broader index. Viv, what is your take on the automotive zone in the Eurozone? Yeah, that's probably that's your question rather
negative. People don't realize this, but driverless cars are here. They already are here. A company called Waymo in the US has done 4 million rides in 2024. Okay, think of it this way: if you took 4 million rides in your car, what's the chance you're not going to kill somebody? Pretty high. If you drove every day 4 million rides, basically, think of this way: if you took one ride per second, it'll take you 10 days to do 1 million rides. 4 million rides will take you basically over a month at 1 second. This is the kind of numbers we talk about. You haven't had a major disaster with Waymo for 4 million rides. That pretty much indicates that they kind of solved this thing. This is a safe, solved problem. Now, if you're looking at these driverless vehicles, they are very cost effective. They are, like Uber, but much cheaper and much safer because you don't have to talk to or deal with a driver. The two parts of the world that have got the technology are Tesla and China. The EU is not there. I don't know if people are going to be going for the Mercedes Benzes and the Alfa Romeos and stuff into the future when you have the majority of people just using these driverless taxis as their main form of transportation. Electric vehicles as well. The Europeans are just behind on this for whatever reason. So yeah, the Eurozone automotive sector, I'm telling you right now, is going to be probably one of the worst places to invest over the next 10 years, just because they don't have the technology to do what needs to be done, and they're not positioned in this marketplace. The Eurozone cars, the BMWs, the Volkswagens, etc., are more expensive than the Chinese models, right? Don't have the technology these Chinese models have. And they don't have the driverless technology, especially that is really going to be in play in the next 10 years, unfortunately.
Yeah. So again, I suppose speaking to the point of like a direct investment in the Euro stocks, hoping to try and get, an above a 12% compounded average is probably not going to work out for you. But will BMW, in the same case, do you think BMW and that, let's say Volkswagen, has the potential to totally collapse in the face of driverless cars, enough to influence the Euro stocks index to leave us negative?
No, I think basically these are such important parts of their economy. And Volkswagen means people's car. It was invented by Hitler, effectively, and has been a government-linked company for ages. Renault, you look at what's happening in that company, again, government-linked forever. And so you look back, at these European car companies, European, big manufacturing companies, they have such massive government support that even if there is a downturn, they will be much more supported by their government than, for instance, you'd find in places like the US.
Okay. So not going to perform well, but not going to perform badly.
At least not in the foreseeable future.
Not in the foreseeable future. Yeah. Okay. Thanks, Gary. I might have missed this. No, thank you. That's actually a great point. I did have it in there. I don't know if it was there. Yeah. So the cost, remember, all the costs on all of these products are like the product is essentially after costs. So yes, so we take essentially a 3% fee plus VAT for the duration of the product, but that coupon and that return, it's not an over and above cost that you're going to pay. So it's all built inside the product, and that's a really important question. Thanks, Bruce. I can't believe it. So just to understand, like everything that I've showed you, that's an after cost return. Everything that we're working on here is after cost. It's all embedded inside the product. And essentially for the structuring and all of that. And so we typically, like I said, our cost will never change as well. It's like, and sorry, the next question from Brett is, do you have a fact sheet on this product? Which we do. When we and the cost is in the fact sheet as well. And it's a full breakdown of the cost as well. But we'll send the fact sheet out with so obviously you guys have been on the presentation. So anyone that registered is going to get just a copy of the webinar, just posted on a YouTube channel as usual. But we'll also include the underlying fact sheet. We kind of did this one as more of a secret thing. Yeah. But we're going to supply, like I said, we've got, and we're taking orders until the 17th. So you'll probably also get an email from us probably Sunday or Monday, just with the full terms of the product as well. But the costs on the cost side, we take a static 3%, which if you look at that like over a 5-year period, that's significantly cheaper than what an average asset manager charges you at, let's say 1%, 1.25%. But even then, this is not over and above. So if you invest $100,000, you're going to get that 12 to 14% return after our cost. Our cost is embedded in the product.
The guarantee is on the 100,000.
Yeah, and the guarantee is on the 100,000. Like the cost has no effect on that. And it's not like when you put the product in your account that you're suddenly going to get this like 1% fee after it, and you have to have extra. Whatever you invest in the product, that's what your return is based on. All the costs are included. Yeah. So, and like I said, our cost is static, and it's in the fact sheet that we supply to you. And it's important that I can't believe I didn't put it in the presentation. I just forgot. But it's important that also that like our costs are static, and it's a very important consideration because a lot of what these structured product people do and people that structure products is they'll kind of put their they'll put their cost in, and then suddenly like they'll get a much better terms on their trade, and they go, all of these guys signed up for 12%, let's just give them 12% and make our fee 6%. We would never do that. Like our cost is a static 3% for the structuring, and all the benefit flows through to you either in that enhanced coupon or it flows through in the enhanced return profile. Remember, these are also listed products as well. So if you've got a Bloomberg terminal or a Reuters terminal as an industry professional, you can literally go and take the ISIN number that we get, and you can go and stick it in your Bloomberg, and you can go and look at the product as well. So you can actually go and check this stuff after the fact, which is great. So, they are weirdly, for what seems like an opaque product, it's actually really transparent. So yeah, like I said, that's a 3% structuring cost. Okay, so we got lots of questions here. So do you strictly need to open an account with Ransus, or can you subscribe to the product on other platforms as well? So you can technically, like I said, we offer 3 different platform custodian options, which is the DMA, Velocity, and Swissquote. There are other custodians that can handle the product as well. So, like I think Ramsey Cook Hall is one. So generally, as long as it's an international broking account, you can hold this at other platforms. So you don't have to have an account with Rand Swiss to buy the product. It does generally make it a lot easier because, I mean, obviously, especially if you're doing an international transfer, I mean, we've got like obviously the wealth management services. So, all the little nuances of like, settling transactions and all of that, if we do it internally, it's just kind of like, it's so seamless. It's like do an EFT and you get invested in the product. But yeah, I mean, by all means, I mean, just pop us an email with your underlying custodian. One of our administrators will contact them and ask them, if they can clear through Euronext. I'm not sure on the, like I said, I think I'm not sure on the local equity platform. So, if you've got one of the local brokerage platforms, even if they have international options, it's not always possible. I think ABSA and Standard Bank can handle them through their web trader services. I don't know if Shift can. Easy Equities also, I'm not sure. But yeah, I mean, just pop us an email. Like we're happy to kind of like almost take the order, and then we'll deal with the underlying platform to see, and then we can just give you a yes or no. If it is a no, I mean, setting up an account with us, they're low cost. I mean, these days stockbroking has become, it's a kind of a race to the bottom platform game. So we literally would just set you up either a Swiss bank account and use the custodian for you. So the best thing to do is just pop an email to info@randswiss.co.at.com, not .co.za, randswiss.com. And and then we take it from there. And then we'll do the inquiries based on your specific brokerage platform and brokerage account.
Yeah. Also, the great thing about having these kind of structures in a dedicated platform that we have is like, for instance, you don't mix it up with your shares and other portfolios, because if it does close in like a year, having it like, part of a trading, platform where you're buying and selling stuff every 5 or 6 days, might, sometimes affect things like your taxation considerations.
100%. Yeah.
So you probably do want to have a specialized account to hold these things.
Yeah. But definitely possible as well. So, all right, cool, guys. Thank you very much. I think we over time by about 4 minutes. Hope you enjoyed. And if there are any questions, you know where to reach us.
Email us.
Yeah. Thank you very much.